while very important, are not cohesive, are not holistic. Fundamentals alone, technicals alone, derivatives research alone, macroeconomic research alone, all of them talk in their own language, but they don't talk together. So with quant, what we've tried to do is actually bring all these different styles and sciences in one. So my macro models also tell us how to go about investing. My fundamental models also tell us how to go about investing. We have an overlay of technicals, which again support our investment decisions. As and well, we have an overlay of sentiment analysis as well. So the point is, we didn't want to start our new journey of investing by challenging what PL is good at, which is fundamental research. We said, let's enhance it. Let's make it better. So we decided to make a team of absolute specialists, economists, Python programmers, CMTs, risk analysts, FRMs, statisticians, mathematicians, fundamental analysts, CFAs, CAs, all of them, to make sure that all of us can talk together and our computers can do the same. So instead of defining or defying fundamentals, we said, let's take fundamentals as a base, but let's enhance it using quantitative techniques. And that is why when I say that now we are investing in an era of man with machine. And to support this, I will show you all what is really happening in the world out there and the journey India has to cover. It's a long journey. We're not even off the mark. Indian assets under management managed quantitatively are less than 0.5%. And when I show you all data for America, China, etc., we are crossing 35%, which means India is not even started. And there's a lot of work to be done in this field to take investors and offer investors more sophisticated investment solutions. Again, this is just a brief about PL. I'm assuming most of you all are aware because PL has been around for very long, but we are an integrated financial services ecosystem. We operate under the following 6 businesses, starting from wealth management, investment management, broking, institutional equities, investment banking, and we also have our own NBFC. And I personally am representing the investment management and advisory arm of PL. And this is just a summary of some of the key awards we've received over the years and how our brand has been one of the most trusted brand in the financial services space, mainly known for its expertise and integrity in the domain of research and capital markets. This is some of the key members of our team as we stand today. Myself, of course, I'm the fund manager and the head of investment strategy. Amisha Bora ji is our chairperson and managing director. Dr. Punita Kumar Sinha, again, she needs no introduction. She's also the chairperson of the funds management arm. She's got more than 35 years of global asset management experience. She's been the CIO and head of the BlackRock Asia investment arm. And we have Nupur Patel, who looks at the sales and marketing and the business of our PMS vertical. Okay, so now before we start as to why we think quant is relevant or quant investing is relevant, we need to start at some of the key problems all of us face. So what we decided is we show you all the different biases that actually hamper our investment decisions when we are in the process of evaluating data, meeting companies, meeting a management, visiting a factory, talking to analysts. That's the broad process of traditional investing. Usually something called confirmation bias. Confirmation bias tells us that when we have made a view that you like a company and then you read data on that, your mind will only process that data which confirms with your view. It will reject that data which does not confirm with your view. So when you read 10 news articles about a company that you have invested in, you will give more weight to those that are talking positively about a company and less weight to those articles that are talking negatively about the company. So that is one key bias. The other one is anchoring bias. You decide, say, assume you're somebody who started their investment journey in 2006. So before 2006, you guys have seen a massive bull run. When the 2008 crisis is happening, it's starting, your mind is not able to believe it because you're like, no, markets are always going up. They can't go down. But when 2008 happens, your anchor of 2006 gets shaken away. And then you move into a new anchor of 2008. So you take time to realize that things are changing. Now, when you come into 2010, when there's a huge recovery in the markets, again, you're in disbelief because you've just come out of the scars of 2008. So you're thinking, no, how can markets go up continuously? We've just seen such a big crisis. Every move up might be an opportunity to sell. And that is how people get tricked by their own emotions. And we've seen this again in COVID. Those who waited through the cycle, sold at the bottom, could not come back in thinking that abhi wapas niche aayega. That's when I'll jump back. But markets never gave you the opportunity. So there are a lot, disposition bias talks about that. That once you sell at say an 8,000 level at Nifty and markets are at 10,000, your mind is saying till it doesn't go to 8,000, I'm not going to go back because you already sold at that level. So the simple point is there are a lot of emotions. They hamper your decision making. Greed and fear is the key cause of all the concerns that we see in the market. When you go into a world of quantitative investing, you rise above all of this because you're talking to data. You're talking to objective rules, systems, processes. When these make decisions for you, you don't have to deal with the emotional biases that come along the way. So again, the way we summarize all of it is that humans are emotional, but humans are also intelligent. What we are trying to do is let go of the emotions, but retain the intelligence. So all the quant work that we have done in India is basically drawing from the investing wisdom, the market wisdom, the research insights that PL has developed over the years, but put it all together in systems and processes, which we've taken more than 4.5 years to do. A team of 16 people working 24/7, 365 for the last 4.5 years in order to do this. And as a quant team or as an investment team, what is our real job? What is our day-to-day work? Our job is to make rules, is to make processes, test it out. We don't make investment decisions. We make rules and processes. These make investment decisions. So if something is going wrong here in the decisions part, we don't tamper the decision or we don't sell a stock. We say which rule allowed this stock to come in, or why did we get this wrong? Change the process, not the outcome. Again, this is a very simple overview of what is quant investing. I'm assuming by this time, most of you all are aligned with me in understanding what we're talking about. So what we're trying to do is have a data-driven, scalable, automated, and unbiased way of making investment decisions. That's what it is. You get data in, you process it, that data and that process throws output to you. That output is your investment decisions. And when you can test this process for multiple years, you know whether your system is working or it's not working. It's as simple as that. Again, some important advantages of doing this is you become away from key man risk, fund manager risk, fund manager style biases. Again, this is a very, very transparent process. You know every decision that is being taken by your models, why it is being taken. So we are not operating in a black box. As I explained, you get inputs, you get a process, you get output, and then you refine it. Again, the whole point is try to make this as objective and systematic as possible. And we've been able to do it over the last couple of years. So all of this gets us to the edge. Why? By doing this, can we deliver an edge to our investors, to our clients, to our distributors? And yes, we believe so. And our numbers also support the narrative. So firstly, there is more of a mathematical orientation when you take this approach, as opposed to an intuitive orientation alone. Again, as I said, we take data-driven decisions. So we process so much data that we are able to capture things that we otherwise might miss with the naked eye. When we look at global economies, we look at global markets, we look at global asset classes, we look at Indian markets, we look at Indian stocks, we look at fundamentals, technicals, alternative data, sentiment data, a lot of things. So for me personally, if I want to be the best fund manager in the world, can I really process all of this and make decisions in a repeatable way again and again? No. But if I've made a system to do it, I can trust that it will operate in the way I've designed it to operate. And that is the confidence and conviction you get by moving from a pure traditional active approach to a system-driven approach. And this is to show you how US has really been in this landscape. So the blue bar suggests how quant assets have grown in America over the last decade or so. So we've seen an 18% CAGR in AUM on the quant side. We've seen an 11.5% CAGR in AUM on the passive side. But what surprisingly we've seen is a very low 1.8% CAGR on the active side. And what we also know is that 30 years back in US, 75%, 78% of all assets were managed actively by fund managers. Today, less than 16% is managed actively. 45% is managed passively, index funds, ETFs, etc. 35% is managed quantitatively. Quant rules, system, process, all of that is managed systematically, basically. And only 15-16% is managed actively. In India, less than 20% is managed passively, less than 0.5% is managed quantitatively, and a big chunk of 80% is managed actively. So now you all can visualize what kind of a transformation or growth this can lead to for the quantitative asset management industry. Again, 35%, as I just said, 35% of assets are managed quantitatively in USA. And this is how India has grown over the last, since 2007. We've grown 220x, but don't get too impressed. The base is very, very low. This number that we see is less than 0.5% of India's total asset management industry. So while the growth rate is very high, but the absolutes are still very low. And this again, this is a snapshot of the top 10 funds in US. Why? The only reason I show this is so that you all know the size and scale of, if this is done well, where can this go? So we have funds which are between $60 billion to $120 billion. And on an average, they've been around for the last 20 years or so. Very few have a pedigree before 20 years. And just another heads up. So Renaissance Technology, which is managing $106 billion, has a since inception CAGR of 67%. It's better than Warren Buffett. There's no other fund manager in the world who's been able to replicate this performance. And that is only because they use a systematic way through and through cycles. Usually what we see with the active way of managing money is that in some cycle, a certain fund manager or a certain styled fund manager does very well. In another cycle, altogether another fund house, another fund manager does very well. Which means everybody plays to their strengths in some part of the cycle, not throughout. But when you take a quantitative approach, you can program, you can model it in a way, and you design your strategies in a way that you can try to outperform through and through market cycles. And this is again how quant assets have grown in China since 2018. This data might be slightly dated, but this is the last update from China that we've got. So again, they've jumped fivefold in 2 years, that in the period that we are analyzing. Again, why do we believe quant is the future? Because there's availability of data. We have access to technology as a country, and we have the talent in India today that can combine the technology and the financial domain expertise to bring out creative and innovative solutions for investors. And that is why we believe quant is the way to go. And few other things that we feel are relevant to understand is the way US market transitioned from active to passive and quant. There was a big reason for that. First, the fees. When you're paying fees for alpha. Passive instruments basically tell you that don't pay me fees, you won't get alpha, but at least you will get market returns. So a big part of the investors start thinking, okay, I don't want to pay fees and risk underperformance. I'd rather just get market performance and pay no fees to get that. So Vanguard has become the largest asset manager because of their passive instruments. When you pay fees, you want alpha. But the data doesn't suggest that in US. Active fund managers are not able to outperform benchmarks, indices, etc. And that is obviously because US markets are very efficient. the more you become efficient as a marketplace, the less alpha you can generate. The only thing you can then capture is beta. But good news for us, fortunately for us, India is still an alpha market, and it will be so for the next 10 to 15 years at the least. As our markets become more mature, more efficient, more developed, more regulated, and has much wider participation, that is when our efficiency starts going up. When our efficiency starts going up is when our alpha component starts coming down and our beta component start becoming more important. So right now we are still an alpha market, and that is why all the global funds, all the global assets are actually investing in India. And with China's own goal, India is getting even more foreign flows. So for the next decade, I think India is very well positioned to deliver alpha at a global level when it comes to equities. Okay, this is just how the industry works in terms of pricing. Again, this is more informative, less relevant to us at this juncture, but still it's important to go over it. So the way India stands out here is, in terms of fees, we are still able to command 1 to 2.5% fees. When you look at US, they start at 0.5. When you look at UK, they start at 0.75, cap at 2. So India still has an opportunity to charge fees, at the same time estimate a higher alpha for investors. So our alpha range is also between 10 to 20. As compared to most other markets, we stand out tall. And that is why I said India is still an alpha market for the next decade or so. Again, this is a summary of everything we've discussed. If any of you all want to take any notes, maybe take a photo or something, that we eliminate fund manager style biases. We take a very, very analytical approach. We make sure all the human and emotional ups and downs that come along with active investing, we try to make sure they are out of the picture. We make sure that we don't follow a black box model. All our strategies are logical, they are intuitive, they are rules based, and they can be explained very systematically to investors and to everybody. A black box model is one where you can't really explain what's going on, and that is also a way of quant investing. That is also a way of quant investing. But the problem with that is you yourself don't know what your computer is doing. So when you hear buzzwords like AI and ML, be very, very careful, because AI and ML usually goes into the world of black box. We don't operate there. And again, the breadth, speed, and accuracy of processing data is simply much higher when you use computers and machines to power your investment decisions. Okay, this is for those who want to learn how to evaluate whether a quant strategy is good or it's not good. What we decide is, first we try to understand the strategy. Is there an asset allocation strategy? Is it long short? Is it long only? Is it passive? What is it? What is the objective of the strategy? Alpha generation, absolute returns, consistent returns. What is the objective? What do the returns, historic returns look like? What are the risk measures such as Sharpe ratio, Sortino ratio, alpha ratio, etc.? And finally, what is the framework or the set of systems and rules that is going to drive this performance? That is very, very important to understand. And just a quick stop before we go into AQUA, because that's going to be a much deeper dive into the strategy. This is multi-asset dynamic. This is our first quant product that we launched 2 years back. And again, the strategy is very, very simple. We want to invest in the right assets at the right time. This is for conservative investors. This is for investors who can't take risk, who don't like risk, who don't like volatility, but they still want inflation beating returns. They still want returns better than FD. It's for that audience. So with that, what we decide is we make sure that we divide the markets in 2 phases, as I explained here. 1 second. Capturing gains, avoiding losses. These are the 2 phases that we decide. And when we want to capture gains, we basically invest in risk assets such as domestic and international equity. When we want to avoid losses, we invest in risk-free assets such as, or low-risk assets such as gold and fixed income. And the way we do it is, we look at 6 main parameters to decide how to do your asset allocation. Again, this is done quantitatively. We look at multiple global and domestic measures of value. We look at multiple measures of trend. We evaluate global and Indian macros. We look at sentiment. We look at the risk environment, and we look at monetary dynamics or interest rate and liquidity conditions. Again, these are just words. We have close to 100 plus indicators behind this to actually give us answers. And the way the model works is very simple. If these indicators are becoming favorable, you become more aggressive. As they start becoming less favorable, sorry. Yeah, as they start becoming less favorable, you start becoming defensive. And when you do this dynamically, the advantage you get is in a good cycle, in a bull market, you make returns. And in a bear market, you don't lose those returns. And when you're able to save drawdowns, that itself is a huge alpha in the long run. Again, even in MADP, we've been able to generate significant and consistent alpha over the last 1 year, as we see. And this is the first product that we did in quant, and that was an experiment, and it went very well. And that is why we've launched our second product, which has got a much wider appeal and a much larger audience. And the second product is what you guys have come here for today, and that's AQUA. First, before I go into anything, let's just start with the performance, and so that you guys know that this works, and then we go into how this performance is really coming. So we launched the strategy around 12th of June. We deployed the first capital around 19th of June. As we stand today, we've already crossed the 50 crore mark on the AUM side, which again, for a new strategy is very good. Usually strategies take 1 to 2 years to mature before they get flows. But the concept is well accepted, and this is our second strategy. So people are willing to invest with us. So what we've seen is, what the fourth A of AQUA is alpha. It stands for alpha. So the final goal is neither the AQUA strategy returns nor the benchmark returns. It is this third line. We are only here to generate alpha. Even in a falling market, alpha can be generated. If your index is down 30% and if you're down 20%, there's an alpha of 10%. So alpha is the only thing we are seeking in AQUA. So over the last, say, 2 months, we've generated 15.3% absolute returns versus benchmark at 3.3. That means an alpha of 12%. Since inception, again, it's close to 14.9%. Benchmark is at 6.6, and it's a healthy alpha at 8.3. So the point is, the numbers are good. They support the narrative. But now let's understand what is the narrative behind AQUA. So we invest in the top 500 stocks of India. We apply some proprietary liquidity filters and fundamental filters to eliminate or basically separate the wheat from the chaff. And what we do here is make sure that we invest in liquid stocks. We don't want to generate returns out of penny stocks here. So the moment we decide that we want to get rid of illiquid stocks and stocks with inferior fundamentals, we set up with an operating universe of close to 300 stocks. Once we are there, we then apply our 6S framework. I will take you all through that to actually decide stocks. Again, two other things that are important to understand AQUA is the frequency. We dynamically rebalance the portfolio. This is not a buy and hold strategy that buys today and waits for 5 years. Neither investors, nor distributors, nor markets operate at that frequency anymore. With faster information, with more liquidity globally, everything happens faster. Business cycles, which were once 10 years, became 8 years, now are 5 years and heading to 3. Business cycles are shortening. Economic cycles are shortening. And how we know that economic cycles are shortening? In the 2008 crisis, the Fed took a lot of time to react and pump in liquidity to deal with that crisis. In the 2020 COVID crisis, the liquidity was pumped in 3 months. And the markets started rebounding in 3 months. So the point is, as we've seen more past experiences, even government officials, global economists become more efficient. And because of the anchoring bias that I spoke about, they know how to react to a certain thing because it's happened in the past. And that is why cycles are shortening. And in a world where cycles are shortening, you cannot be operating at a 5-year time frame. And that is why we rebalance our portfolio and review it fairly dynamically. And the way we go about our allocations is we follow an unbiased method. Unbiased means we are not saying that any one stock has slightly higher potential than another stock in our portfolio. And that is why going for an equal weighted, unbiased approach to investing is more sustainable, is more repeatable. And this is one of the biggest sources for alpha. Imagine if I have a 25 stock portfolio and I give 10% weight to a certain stock because I feel this will do better, and 2% weight to a certain stock because I feel this won't do good. And the 10% stock underperforms and the 2% stock outperforms. I'm basically cutting the chances of all stocks to deliver optimum performance. When I go in for an unbiased methodology, I'm basically saying don't use any constraints. Let the stocks and the portfolio perform based on its merits. And the way the strategy operates is we try to get 5 big decisions right. And we have a model operating for each of these 5 decisions. First, we want to make sure that we are in the right asset class. In a long only equity strategy, what are the asset classes we have? Large caps, mid caps, and small caps. They are 3 different assets. In a tremendous bull market, you will see small caps doing very well. In a less than tremendous bull market, you will see mid caps doing very well. And in a dull market, you might see large caps outperform mid and small. So how you are allocated based on the cycle between large, mid, and small is very, very critical to decide your alpha. And 91% of investment returns are coming from this decision alone: large, mid, small. The second thing that we look at is style. Style means, when do I follow growth? When do I follow value? When do I follow quality? When do I follow momentum? These are different styles of investing. 69% of returns are enhanced by this decision. The other thing we look at is themes or sectors. This again is very, very important. What our research tells us is 73% of your returns are actually coming from your sector selection decision. Again, what does that mean? If you pick a wrong stock in the right sector, as opposed to a right stock in the wrong sector, your odds of outperforming in the first situation are higher. Which means if I got my sector called right, even if I didn't select the best stock there, I will still be making more money as opposed to me getting my sector called wrong. Let's take a simple example. So for the last 2 years, everybody knows IT has been a clear underperformer. On the other side, defense, railways, PSUs, capital goods, industrials have been major outperformers. Which means everybody knows TCS, Infosys, they are great companies, they're legendary, they're gold standard companies, right? So even though I invest in a TCS or Infosys, the companies are great, but they are in the wrong cycle right now. So if I get my sector called wrong, irrespective of which company I pick, I'm not going to make too much money. But if I get my sector call of railways, PSU, defense right, irrespective of which company I'm investing in, I'm certain to make a double, 100% return. So the idea is, when you take a quant approach, you can actually invest like this. When you take an active approach, what we have seen is there are a lot of biases. PSU चलाता है, इसका कोई ओनर ही नहीं है, गवर्नमेंट से ऑर्डर आएगा, गवर्नमेंट टाइम पे पैसा देगी नहीं, पीएसयू में कौन इन्वेस्ट करेगा, देयर इज नो स्किन इन द गेम. ऐसे बहुत सारे रूल्स लोगों ने बना लिए. So they can't invest in PSUs, PSU banks, defense, etc. When you take a quantitative approach, you don't know this. You don't know this because you're saying growth is good, valuations are comfortable, momentum is strong, this is in the right sector, the sector is seeing outperformance, why shouldn't I invest in this? So your models capture this and they invest in this, which is very hard again to do it actively because of all the constraints you build over your investing years. And again, the last thing we look at is the right factors. What we've seen is when we use a blend of multiple factors as opposed to a single factor, our results are much better. Which means when I combine growth, value, quality, momentum, low volatility, sentiment, I'm much better off versus me only saying, I only invest in growth companies. I only invest in value companies. I only invest in high quality companies. That approach doesn't work across cycles, but a blended approach works much better. So to sum it all, AQUA is a holistic strategy, it's an agnostic strategy, and it's an adaptive strategy. These three words are very, very important. When we say holistic, I told you all at the beginning, we combine macros, theme, style, fundamentals, valuations, technicals, risk, and liquidity. We combine all these 8 things in order to make investment decisions, as opposed to looking at one or two of them. And this combination is possible only because we are taking a machine driven approach. The moment I take a very active approach, I'm not able to do this. The other thing that is important is being agnostic and adaptive. Agnostic, in simple language, it means I'm not preferring one over another. When I lose my choice of preference, I'm agnostic. So I'm style agnostic, which means I'm not saying value is better than growth or growth is better than value. I'm not saying anything. I'm size agnostic. I'm not saying mid caps is the only way to invest. Small caps only makes you money. Large caps only makes you. Kuch nahi. Based on the market cycle, I will decide which size I want to be. I'm sector agnostic. I'm not saying that I only invest in IT, pharma, FMCG, and private banks. No, I can invest in defense. I can invest in real estate. I can invest in any sector. Whichever sector is promising in terms of growth, in terms of valuation, in terms of quality improvement, I can invest in that. So being agnostic is your starting point. The moment you come to the table, the moment you enter the ground saying, I will do this, I will not do this, you're reducing your chances of being sustainable across cycles. I'm also benchmark agnostic, which means Reliance has a 12% weight in the benchmark. IT has a 12% weight in the benchmark. Banks have a 30% weight in the benchmark. The moment I take a benchmark pro approach, what am I trying to do? अच्छा इसमें 30% है तो मेरे पोर्टफोलियो में 28% तो कर ही देता हूं क्योंकि ये चला और ये मेरे पोर्टफोलियो में नहीं हुआ तो मैं अंडर परफॉर्म करूंगा आईटी 12% है तो मैं 12% आईटी रख देता हूं 10% रख देता हूं तो अगर आईटी बाय चांस चल गया तो मेरा पोर्टफोलियो बहुत अंडर परफॉर्म नहीं करेगा what approach we take in we say okay based on all the analytics we've done does IT demand a position in my portfolio on its merit not because it's there in the benchmark on its merit does it decide to come in if yes it will be in my portfolio if no the weight will be 0 I'm going 0 in a certain cycle if our models say that banks also don't need to be in my portfolio because we are going through a banking credit downgrade cycle we will not have banks, irrespective of whether it has 30% weight in the benchmark. And in a certain cycle, right now, for the last 1.5 years, we've been overweight industrials, cap goods, defense, railways, PSUs. So industrials have been 40 to 45% of my portfolio, as opposed to benchmark, it's at 4%. So I'm benchmark agnostic. Even when it comes to stock weighting, we are benchmark agnostic. We are not saying if this stock has 2%, so I should be 1.8 or 2.2. I will be at 4%. This stock has 12%. I can still be at 4%. So I'm benchmark agnostic. And again, our portfolio is stock agnostic as well, which means a single stock is not driving the returns. All the stocks are driving. There is granularity in the portfolio. Once I take you all through a few more details, I'll elaborate this concept a little bit better. And it is schema agnostic, which means right now, I am the fund manager. I am the designer of this strategy with my entire team. And the strategy has reached a certain stage. But if something happens to me, the strategy can still operate. What we have seen in the business of active funds management, there is a lot of key man risk. For example, take some very large institutions. I would not like to name anybody, but in a large institution, if the CIO or the fund manager changes, there is a risk that a new fund manager will bring a new style, a new approach, a new process to doing things. And therefore, the continuity in the system, in the process is not the same. When you take this approach, you have much higher sustainability in terms of how your strategy will perform or how your strategy will evolve over time. And this is by far one of the most interesting slides of AQUA. And this research of ours has basically helped us build this strategy, right? So what we realized is we divided equity markets into 5 style regimes and economy also into 5 regimes. What we realized then, that when the economy is expanding, growth style of investing does very well. When liquidity is expanding or interest rates are coming down, momentum style of investing does very well. When interest rates are going up and there's a shift in the economic risk regime, value style of investing does very well. When there's uncertainty in the economy, quality style of investing does very well. And when there's a contraction in the economy or there's a bear market or a risk off phase, your low ball style of investing does very well. So what is fairly evident is one style does not do well across market cycles. That is very clear. I can't be saying I'll only follow quality and I'll be good. It's not so simple. It's complicated. So multiple styles work across different parts of the cycle. So if we can figure a way to first gauge which macro cycle are we in and then decide which investment style I want to follow, I'm pretty much saying that irrespective of what happens in the future, I'm fairly covered, that I'll adapt my style, I'll tweak my style. Now, this is very, very hard to do on a personal level, on an individual level, at a human level, because everybody builds their style focus with years and years of experience, market experience. So to change it, it's not easy. And it's as similar as saying you changing your language. If you guys say go to Russia, you're not going to be able to speak in Russian, or go to Korea, you're not going to be able to speak in Korean. So your investment style is as close to you as the language that you've been used to speaking. It's your language of investing. And that is only possible with Google Translate. You can go to Korea, you can type in something, your Google translates it for you. And that is why we are also using the help of machines to do this. And the way we call it, this word, delta. Every investment return in the world is coming only from this one word, which is known as delta. Delta means change. Change in what? Either a company's earnings improve, or the company's efficiency improves, or the company's growth quantum improves. Earnings means I was earning 10 rupees as EPS. Next year I earn 12. So 20% se stock chalna, it's minimum. Utna chalna chahiye. But if my longevity goes up, okay, this 20% growth I'll do for the next 10 years, my multiples will go up. So there are 2 sources of returns, earnings and valuations, which lead to change in price. But understanding how valuations will grow is very, very complex. That depends on change in growth longevity, growth trajectory, and quality. Quality means efficiency. ROE, leverage, margins, cash flows, all of that comes under quality. So when we want to capture returns, we basically want a growth in earnings that leads to an improvement in quality, that leads to rising valuations. When this circle is completed is when we see real delta in returns. And some live examples. Go back 1.5 years in your lives. If you guys are tracking markets closely, see how defense companies evolved. There were order books increasing. The government policies changed. They said, we want to make everything here. Indigenization of defense equipment. They said, instead of importing everything, we want to become a net exporter of defense. So they did capex, government capex, to make sure that the defense companies are doing very well. And with all the geopolitical risks in the world today, I believe the major risk India is facing is geopolitical, which means we have an angry neighbor in China. We have an angry neighbor in Pakistan. We have US and China not liking each other too much. And we have Russia trying to spread its own wings in its eastern zone, western zone. And that has led to US and Russia also coming at loggerheads in a very soft way, but still at loggerheads. So when I look at India from a very big picture view, what I see is domestically, we are on a very strong footing in terms of growth, in terms of inflation, in terms of interest rates, in terms of deficit, in terms of debt to GDP, in terms of population and demographics, in terms of employment levels. So our internals are very strong. So at this point of time, everybody knows in the world that India is the strongest economy, the fastest growing economy, the youngest economy. Everybody knows this. It's factored in. So what is the only risk staring at us? It is our neighbors. It is the geopolitical uncertainty. Because of this, our governments also realize this. So that is why they're focused on making defense a very local thing. And now what we saw in defense, say 2 years back, in terms of rising order books, that got played out over the last 2 years. But the prices started going up first. So what happened? Growth was going up, which would lead to a better balance sheet, lesser debt, higher ROEs, higher operating leverage, which would lead to rising valuations. So when we see the defense stocks delivering 300% returns, has their earning grown by 300%? No. They were at 5 PE, they are at 10 PE now. And earnings have also grown by 25%. So it's a combination of growth in earnings and growth in valuations that give you growth in price. So this is what we want to capture. How do we capture this? We capture this by creating factors that proxy this. So we have created our own factors such as quality, growth, momentum, risk, theme, etc. And what we've seen, when valuation factors suggest that these companies or these sectors are slightly undervalued, coupled with increase in momentum, we believe that is a great proxy to track future growth. When growth comes in 3 years later, your price and valuation start going up now. They don't wait for the earnings to come. Markets are always leading. Similarly, the way we've constructed all our factors, we've been inspired by Einstein's theory of relativity. And what this theory tells us is that there's nothing absolute in the world. Everything is relative. So there's no absolute frame of reference. So just imagine two people sitting in a train on the window. The train is moving and both of them are looking at each other. They'll both feel they're at the same point. They're not moving. But the moment one person is stationary and the other is moving, that is when you gauge movement. Otherwise, you can't gauge movement. So relativity is simply telling you that when you're looking at growth, when you're looking at valuations, when you're looking at ROE, irrespective of what you're looking at, measure it relatively rather than absolutely. Why? Because in the FMCG industry, a norm of 25% ROE is a must because of the nature of the business. So if an FMCG company is generating 15% ROE, it's bad. But if an infra company is generating 15% ROE, it's gold. If a private bank is generating 13-14% ROE, its multiple is 3 times price to book. If a PSU bank is generating 10 ROE, its multiple is 1 time price to book. So point is, you can't come to markets saying that I will invest in companies that have 15% ROE. Doesn't work. I will invest in companies that trade below 15 P. Doesn't work. Titan can trade at 40 P for the last 10 years. Why? Because that is the nature of the business, that is the nature of the cash flows, that is the size of the opportunity. So when we look at valuations, we look at it relatively. And relative to what? 3 things. It's past. How am I today versus my past? If I was growing at 20% for the last 5 years, am I growing at 10% now? So am I doing less good than I did in my past? If yeah, then I should be negatively awarded for such a thing, right? Or negatively penalized for such a thing. But if I was growing at 10% before and now I'm growing at 15%, I should be rewarded for it. The other thing I look at is when you look at valuations or growth or momentum, the historic frame basically tells you that if you're better off today versus your past, you should be given points, you should be recognized for that. And if you're worse off, you should be penalized for that. Similarly, versus your peers. Peers are very, very important because that decides and defines which industry structure you're operating in. You can't compare an IT company which generates or has a 70% cash flow to EBITDA conversion to a metals company which in some cycles has negative cash flow and in some other cycle has tremendous cash flow. You can't compare it. So I have to make sure I compare apple to apples and then say, okay, this is good, this is bad. There is no absolute frame, and this is what I was trying to tell. And the last is I compare it to the broader markets as well. When I do this, I get a complete perspective on what is good, what is not, why is it good. And again, I'm not saying this is good because it generates 20% ROE. I am saying it is generating 20% ROE in an industry which is generating 12% ROE. It is available at 15p in an industry where others are available at 22p. That is why I'm finding it cheaper, not because absolute 15 is cheap. And now everything that we spoke about comes together on this one page. And this is the final thing that you all need to all understand about AQUA, which is our success framework. This is the investment framework. This is the investment strategy. This is the process that has created the performance I showed you all on the first slide. We do 6 things in AQUA to get it right. And I've explained most of them to you in different segments. But the first thing we do is sector rotation. Sector rotation means at some point, I believe that industrials, chemicals, metals, and pharma are the sectors I want to be in. So my portfolio will be tilted towards that. But at another point, I believe pharma is not needed. IT is very important and FMCG is very important. Again, my portfolio will change color. So I am dynamic in rotating my sectors. This is very important. As I explained, we do this in a benchmark agnostic way. We are not saying that benchmark में 10% है तो when we want to invest in pharma 10% weight होना चाहिए. No. Benchmark में जो भी weight हो, when we want to invest in pharma, I could be at 30% also because that's the merit of the sector at that time. And we are not married to a single sector, which means at a certain point, I'm beneficial to have a huge weight in a sector. At another point, I'm equally good to have no weight in the sector. So we don't have preferences of, how do I call it? Preferred sectors, unpreferred sectors. If you guys have heard so many different people talk. We only invest in this. We don't invest in this. Ye sector mein to, so we don't have any of that. We are unbiased completely. And our models try to capture only one thing here, which are the sectors where growth is either improving or strong. We want to be in those sectors. Simple. The other thing we do is style alignment. That is the second S of AQUA's success framework. When we talk about style alignment, again, we're trying to do a very, very simple thing. We said 69% of your returns are coming from this decision. Can our models try to capture which style regime we are in, which macro regime we are in? If yes, then our portfolio has to take the color of that. Our portfolio has to tilt towards that style. And that is what we do. This is our 2 big decisions that we make, style and sector. Then we come to selecting stocks. How do we select stocks? 3 things. Superior fundamentals, sound valuations, strong technicals. When we say superior, the word superior itself means superior compared to something else. Relatively better. So relatively better quality and growth. When we say sound valuations, we are not saying cheap valuations. We are saying relatively cheaper valuations. And we are saying strong technicals. We are saying relatively more favorable technical risk reward. If I find a great company on fundamental parameters, but the valuations are exorbitant, I might not make money. Going back to the principle of delta, that you make money when 2 things work in your favor. Rising earnings and rising multiples. So we need rising earnings and the headroom for rising multiples. So these 2 are very important. But if I only stick to these 2, my weight can be very low. Because it is possible that a good quality company, which is trading cheap, might become favorable only 2 years later. So we need to make sure that the technical strength is also strong. The momentum, the sentiment, the volatility. We need those to bat for us as well. When we combine these 3, that is when we get a portfolio that is holistic in nature. Again, only technicals, can I base my portfolio on that? No. Only valuations, can I just keep buying cheap stocks all the time? No. Only fundamentals, can I keep buying the greatest companies of India all the time? No. What do I want to do here? I want to make money. I want to generate alpha. Alpha is only possible when you combine these 3 in your stock selection process. So now to summarize it once again, sector and style, my 2 big decisions. Stock selection happens here. Now the portfolio is constructed. The only thing I need to do is keep managing risk. How do we manage risk? Firstly, we have a very dynamic style of rebalancing. So we make sure we are always aligned to market realities. Secondly, we invest only in liquid stocks. As I told you all, we use our liquidity filters to make sure we don't get our money stuck in liquid stocks. Thirdly, I've already explained to you all about the fundamental filters, that we eliminate 100 stocks based on fundamentals. Fourthly, we manage the portfolio beta. In a great bull market, in a bull cycle, in a risk-on phase, we make sure our portfolio is high beta. But in a risk-off phase, we make sure our portfolio is low beta. The system does it on its own. And the last is dynamic asset allocation, which I told you all. Right now, we've been 80% mid and small caps. Previously, we've been 75% large caps also. So that is the kind of shift that we see in our asset allocation at a portfolio level. So this is the whole success framework that makes sure that our strategy is not dependent on me, on this cycle, on the future cycle. We know what all could change, and we've tried to cover grounds on as many things as possible. And obviously, like in iPhone, there was iPhone 1, 2, and now we're at 15. This is also, as per us, the best that we could get till today, which means my team continuously keeps working on improving this further and further every day. In the world of quant and in life, you can't stop improving, you can't stop reviewing. You need to keep trying to enhance whatever you've done so far. And we continue doing that even here. And again, this is more on risk management, but this is a little technical, so I think we can skip it. And this is important, the returns of AQUA. We have given 5 characteristics to the returns of AQUA. The first is that the outcomes are repeatable because it is based on a system, not on a person. The moment I make sure that a person is generating this return, can I trust him to do it again? I don't know. But if a system is doing it, the good and the bad, I accept both of the system, but at least it's repeatable in nature, which is why I've called it repeatable outcomes. The other thing is granularity. When we construct a 25 to 30 stock portfolio, we want most of our portfolio stocks to do well. And think of India, the cricket team for that, right? In a certain match, you will see Kohli is hitting 200 runs. The rest of the team is not really contributing significantly. India is at 250. And somehow we lose that match. And now imagine another scenario where every player is coming hitting 35, 40 runs, and we reach a 300 total and we win the match. Which situation do you rather have? The Kohli situation where Kohli is the star, key stock risk, key man risk, everything, or a granular portfolio where you don't need to worry that if one player fails, everybody will fail. So we have built a granular portfolio. And even in our live fund that we've been managing, we've seen 80% of stocks have outperformed the benchmark, which is what we call granularity. If I had 3 stocks that gave me 200% return and the rest all being laggards, that is not a granular portfolio. When you have most of the stocks doing well for you, we want multi-bagger at a portfolio level. We don't want multi-bagger at a stock level. We don't want only multi-bagger stocks. Portfolio should be multi-bagger. And this is why I said portfolio. Portfolio should be multi-bagger, not each stock in it. And the last is that we are focusing on alpha. The whole name is alpha. The name of the game is only alpha. If you're paying me fees, you're telling me when the markets are good, do better than the markets for me. And when the markets are bad, I understand the markets are bad, but don't lose as much as the markets. If you're able to do that, then you're justifying your fees, you're justifying your existence. And unfortunately, all those who can't do that should not be able to. And that is the biggest reason why US has seen this big move from active to quant and passives. And the smart philosophy is the backbone of not just AQUA, it's the backbone of AQUA, MEDP, and all the future strategies that we have in pipeline for investors. All our quant strategies have to be smart, systematically designed. The performance must be measurable. They have to be adaptive in nature. We cannot freeze and lock, okay, this is the only way to do it. The alpha has to be repeatable. Every strategy has to generate alpha, but the nature of the alpha has to be repeatable and the attribution should be transparent. We evaluate every quantitative model or strategy on this smart philosophy. If it doesn't meet the criteria of the smart framework, we reject that strategy. Again, this is all just basic, no emotional style or behavioral biases. We want to make sure all strategies have none of these. And this again, I believe, is a very, very important thing, not just from an investment perspective, also just generally in life, because I truly believe in this, right? So there's a difference between short term and long term. But in the markets, we've seen a lot of people stressing too much only on the long term, not on the short term. And it's like me saying, I want to have a six pack, I want to be very fit, I want to be all this, but on a day-to-day basis, I'm not doing anything about it. But it's an aspiration कि fit होना है. But how will you be fit if you don't work out every day? If you're doing SIP, that's when your portfolio is getting built. Similarly, if you want to be healthy, you want to make sure every day you're doing something towards that in some measure. So what we say is there's a difference between knowing the right thing and doing the right thing. Everybody knows what the right thing is. Very few people can actually follow it, and those are the few who need it in life in whichever field they have. So with Quant, we bridge this gap of I know that I should have gotten out of IT long back, or I know I should have been invested in defense long back, or I know I should have not been in consumer durables for the last 1 year. पता होने से नहीं होता. Till you don't act on it in markets, in your portfolio management, you're not able to capture that into your portfolio. And what inhibits you to act? As we all see in our daily lives, some style biases, some emotions, some of the other behavioral traits that inhibit us to do what we also know is the right thing to do. Lack of conviction so many times. So what we have done in AQUA is, we say that yes, we have to reach here. This is my final goal, but I'm not going to reach here like this. If I don't do well in my short-term performances, there is no way I can get alpha in the long term. So our portfolio is designed to capture alpha in the short term, which means every 2 months, I keep reviewing and checking, am I generating alpha or not? If I'm not, I shouldn't believe that in the long term, suddenly one day I will, right? And this is the data that backs the theory. I think this line is very important. Long term comprises of multiple periods of short term. To outperform over the long term, you can't ignore outperformance in the short term. And I see this as a market participant happening prevalently in the industry, and which is why I also wanted to bring this up. That people keep talking about 10 saal, 5 saal, 10 saal, 5 saal. Please make sure that the journey is broken down, systematically. So this is the data that tells us that how much do we get it right. Okay. So when we evaluate the strategy on a back-tested basis since 2006, 60% of the times we get it right on a monthly basis. How do I define getting it right? We are beating the benchmark. If we are beating the benchmark, I've got it right. So if I look at my portfolio once every month, I'm doing better than the benchmark 60% of the times. If I look at my portfolio once every quarter, I'm doing better than the benchmark 70% of the times. If I look at my portfolio once every year, I'm doing better than the benchmark 85% of the times. When I move that window to 3, it's 95. And when I move that to 5, it's 99. It's actually 100, but I just didn't want to write 100, so I said more than 99. So that means that yes, we are getting it right for this kind of numbers, but that also means we're getting it wrong. So if an investor comes that, okay, you have this gold mine, now take my money and give me 100% returns, or always keep outperforming. That's also an unrealistic expectation, right? So on a monthly basis, we get it wrong 40% of the times. But we know that 60%, the moment you get 60% of your decisions right, you're already going to make significant money in the long term. And this also shows one more thing, that as you keep increasing your time frame, your odds of getting it right improve. And equity, anyways, as an asset class, is a 3 to 5 year asset class. It's not a 1 month asset class. And this again is showing you what I showed you all in a table of how much alpha we are generating and how frequently we are generating. So what is evident is on a 3-year rolling basis, let's take that, we're generating between 5 to 30% alpha. Obviously, in some cycle, we obviously don't generate alpha also. But when you look at a 5-year rolling basis, 5 to 25 is the range of alpha that we operate in. And throughout, we've been in that range. And again, this data is since 2007, 2009, 2011. So this is long-term data. Okay, this again, clients have fun with this. So this is what we call the happiness index. So as an investor, what kind of emotions are you likely to feel when you invest in a fund like AQUA? So the blue color is basically saying that you're delighted. The light green is saying that you're happy. Yellow is saying that you're moderate. Sad is red. And extremely sad. You're coming home and going to catch me by my collar is black. So when you look at the performance every 1 year, these are the kind of emotions you're likely to experience. When you look at your performance once in 3 years, these are the kind of emotions you're likely to experience. But if you look at your performance once in 5 years, which nobody does, everybody says, but nobody does, you're supposed to be delighted through and through. And how do we define this? Again, there's a logic to that, right? So on an absolute basis and a relative basis, if you're outperforming, you will be delighted, which means portfolio is up 20%, benchmark is up 10%. So on both, I'm doing well. For absolute positive, relative positive, delighted. Absolute positive, relative negative, I'm happy. Benchmark is up 15%, I'm up 12%. Okay, I'm happy. My portfolio is up, my money is not good. Moderate is one level below. Benchmark is down, and I'm also down, but I'm down less than the benchmark. That is when I'm moderate. Then extremely sad is, I'll just tell you all, benchmark is up and I'm down. That is extremely sad. That's not acceptable. So very few instances, I guess, over here in 2020 that investors would have been extremely sad. But again, as we evolve the time frame, we've seen investors coming back to the delighted zone. Again, this is more technical of the whole process of how we construct our portfolio. And I think we can avoid it for this forum. This is how dynamic our asset allocation is. As I was saying, that we don't stick to the same asset class through the cycle. Sometimes we become large cap overweight, sometimes small cap overweight. But on an average, on a historic basis, we do 30, 30, 30. That's the kind of average we've achieved over the last 18 years. Again, everybody must know this is a flexi cap PMS. It is not multi cap. It is not large cap. It is not mid cap or small cap. It is flexi cap. Flexi cap means sometimes you will be very overweight in certain asset class. Sometimes you'll be very underweight. You're flexible. You're unconstrained. And we were in the top 3 in the flexi cap PMS category in India in the latest industry report that came out a month back. We're awaiting the next month report, hoping that we will be in the top 3 again. This is again, I mentioned smart beta, that in some cycle we increase our beta and in another we reduce our beta. So this basically shows you that more visually. And this again tells you sector rotation, that we dynamically change our sectors. For example, in the COVID year, healthcare was our largest bet. But in the next year, healthcare is out of the portfolio. Industrials and automobiles have become our largest bet. For example, consumer staples and IT has been a big bet in this cycle. Again, we've not seen much of IT or consumer staples as we go. So point is, the principle of sector rotation helps you stay aligned to the realities of the market rather than be in a mental bubble that this will do well or only this will do well. It breaks you out of all those things. And again, this is the performance. This is as of 31st August. And the moment I updated till today or yesterday now, this number has been 18%. This number has been 17.8%. The alpha is 13.5 and the alpha is 8.8. More updated version, but again, we can use this as a reference anyways. And this is the historic backtested performance pre-launch. So what we've seen is since 2006, it's delivered 25% versus benchmark at 10%, which means average alpha for the last 18 years has been 50. On a 15-year period basis, 30% returns, 13% benchmark, 17% alpha. On a 10-year basis, 28% returns, 13% benchmark, 14%. So the point is, till we are north of 10%, on a 3-year basis ka alpha, we are comfortably home. And I think this strategy does that. That's it, guys. I'll like some questions, some interactions, some tea, coffee, and snacks.
I have one question. So you sometimes when fund managers are bullish on markets, they think it's overvalued, they stay high on cash. Does that philosophy apply to the strategy?
Yes, absolutely.
So you can have cash positions.
Yes. So if my macro models, which I didn't go into too much detail today, but my multi-asset fund, I told you those 6 things, right? Value, trend, risk appetite, sentiment, macros, and monetary dynamics. This is my macro asset allocation model, which will decide in which cycle am I better off not staying invested only, and in which cycle I'm better off just staying invested but choosing sectors or stocks differently. So in AQUA, we will see most of the times we will stay invested because it's a long only strategy, but only when there is a global systemic risk is when we want to stay on some cash.
Okay. And in your backtesting strategies, how did it work for say a 2020 crash?
2020 crash, yes, we did correct with the portfolio, but again, our drawdowns were lower than the markets. I think significantly lower. So if the markets were down close to 40%, if my memory serves me right, we were down close to 22%.
Okay. And which sectors was the strategy focusing then?
I showed you that chart also. We were more focused on FMCG and pharma in 2020. Completely FMCG, pharma, and towards the second half of 2020, we moved a little bit, also started moving towards IT, which we held for the whole of 21, and then we were out. 22 onwards, we've been out of IT.
Okay.
You'll have only 25 to 30 stocks.
25 to 30 stocks. Yeah, I'll have 25 to 30 stocks.
You said about combining all fundamentals. So what is there's a different signal like trade market at present it says that trade should go up. But RBI is holding it back,
that shouldn't affect me too much
because fundamentally it should be going up. So there's a contradicting signals coming. So how does your strategy work?
Okay. So what is happening on the macro side, on the interest rate side, that will affect my MADP strategy, which is a pure asset allocation strategy. This by nature is a long only equity strategy predominantly,